So, the new inflation numbers for December 2025 are out. But that main number everyone's talking about, it really doesn't tell the whole story. Today, we're going to dig into what's really going on behind the scenes with the data and figure out why your wallet might be feeling a much bigger pinch than the official numbers suggest. Let's get right into it.
Okay, so here it is, the official number from the Bureau of Labor Statistics. The Consumer Price Index, or CPI, shows prices are up 2.7% from this time last year. Now here's the kicker. That number is exactly the same as last month. That suggests that all the progress we were making in the fight against inflation might have just hit a wall.
So 2.7%. On the surface, that doesn't sound too bad, right? But hang on. If you've been to the grocery store lately or paid a gas bill or, bought pretty much anything, you're probably thinking, no way, it feels a lot higher than that. And that begs the question, is this number really capturing what's happening to our money?
So let's talk about why 2.7% is a problem. I mean, it was pretty much what economists were expecting, so no big surprise there. But it still kind of leaves the economy in this awkward, tricky spot. To really put that 2.7% into perspective, you have to look at the Federal Reserve's target. Their goal is to have inflation right around 2%. So yeah, we're still running way hotter than we should be. It helps explain why so many of us feel like prices are just, uncomfortably high. We're definitely not at the finish line yet.
And you know what? It's not just you feeling this way. The experts do too. Take a look at this quote from Mark Zandi. He's the chief economist over at Moody's. He puts it very bluntly. The bottom line is, I think inflation is still uncomfortably high. That feeling we all have is real, and as it turns out, there are some very specific reasons for it. Okay, so the first reason for this disconnect is a little weird. It's not about the economy really, but more of a statistical anomaly. Basically, a glitch in the data itself, and it was all caused by a huge disruption down in Washington.
You probably remember that record-long government shutdown that kicked off on October 1st. Well, here's a strange side effect. For weeks, the federal statisticians who normally go out and collect price data, they couldn't. They were stuck. And that created this massive blind spot right in the middle of their reporting period.
So what did the Bureau of Labor Statistics do? Well, they couldn't just leave a blank space. So for a lot of things, they basically had to guess. And their official assumption was that for many items, prices didn't go up at all in October. As you can probably imagine, making an assumption like that had a major ripple effect on the final annual number. So just how big of an effect did it have? Well, according to Moody's, if you actually correct for that data gap from the shutdown, the annual inflation rate isn't 2.7%, it's really closer to 3.0%. So one of the main reasons the official number feels a little low is because, statistically speaking, it is.
But hold on, the data glitch isn't the only thing messing with the numbers. There's another kind of hidden force that's been pushing prices up for a while now, and that's tariffs. All right, just a quick refresher for everybody. A tariff is simply a tax that gets put on goods that are imported from other countries. And the really important thing to remember here is that it's the U.S. company that's buying those goods that actually pays the tax. And believe me, that tax adds up. Mark Zandi, the same economist from Moody's, estimates that tariffs alone have pushed the overall inflation rate up by more than half a percentage point. He even suggests that without them, we might already be back at the Fed's 2% target. Think about that for a second.
So how does this actually end up hitting your wallet? Well, it's pretty straightforward, really. First, a tax is put on an imported product. Then, the company in the U.S. that's importing it has to pay that tax. And finally, to cover that new expense, businesses often have no choice but to pass at least some of that cost on to us, the consumers, in the form of higher prices. So we've got data glitches and we've got tariffs pushing prices up, but even that doesn't fully explain the sticker shock so many of us are feeling on just everyday stuff. So let's get to the real heart of it, why this feels so personal. This, right here, is probably the biggest piece of the puzzle. That 2.7% number is an average of, everything. But the inflation rate for the things we absolutely have to buy, the true necessities, is going up at a much, much faster clip.
Now just look at these numbers. This is the real gut punch. Over just the last year, the price of coffee is up 20%, beef up 16%, and the natural gas you use to heat your home is up 11%. These are not small, insignificant changes. These are massive jumps in the cost of living.
And it's not just a year-over-year thing. If we zoom in on just the last month, from November to December, prices for groceries and for eating out both jumped 0.7%. And get this, utility gas prices took off like a rocket, shooting up an unbelievable 4.4% in just a single month. That's the kind of short-term pressure that can really strain a family's budget.
Okay, so after all of that, the data glitches, the tariffs, the insane price hikes on staples, the big question is, where do we go from here? Let's take a look at what the forecast says and the different forces that are shaping our economic future.
Right now, you can think of the economy as being in this massive tug-of-war. On one side, you've got those really high prices for food and energy, plus the tariffs all pulling inflation up. But on the other side, you have things like weaker rent growth and the Federal Reserve keeping interest rates on pause, and those things are trying to pull inflation back down.
So, is there any good news here? Well, yes. The general agreement among economists is that we've probably already seen the worst of it. They believe inflation has hit its peak and will likely start to cool down in the second half of 2026. So, relief does seem to be on the horizon, but it's not going to be immediate.
Which leaves us with the final and really the most important question of all. The data says prices may have peaked, but that doesn't mean prices are actually coming down. It just means they might stop going up so fast. The real question is, when will that shift finally, actually, translate into some noticeable relief for your bank account? That's the story we're all going to be watching.